Yes, it's BT Dollars back for another video, and today I'm discussing why I think the S&P 500 is not going to move for 10 years. Why I think there's going to be a gold bull run. There's a lot to discuss, and we're going to be mentioning the unemployment rate, inflation rate, the looking at the market moves in the historic times. So please do stick around, but do subscribe, like, and comment. But as I said, let's get straight into it. Late 60s, unemployment rate was below 4%. Below 4%, right? That's very, very important. And we're going to keep coming back to this theme of under 4% unemployment rate. Of course, we had a recessionary period. Unemployment rates rose. Why? Because inflation started coming up high in 1969. Look, late 60s, early 70s, inflation was at 6.4%. Huge inflation there. So we had to have a recessionary period to increase unemployment rate. And that's what's happened. Boom. We came back down a bit. We didn't get below the 4% mark again. So, what did we have to do? Well, inflation started going high again in 74, 73. Look at that. We were up to 8, 9, 10%. So, what did we have to do for a recessionary period? Bring down inflation. Unemployment rates rose throughout 75. And then, of course, unemployment rates came down till late 70s, early 80s. Then, what did we have to do? A recessionary period again. Because why? Well, look at that. Late 70s, early 80s. Inflation was at 14%, so we had a recession and unemployment rates rose. And there we are, look, you can see it again and then again there as well. Because inflation was so high, we had to have a sort of big recession there to bring it all the way back down to the levels we want it at, which is at 2%. But let's just see how the markets moved. So yes, as you can see on your screens, the S&P reached a peak of $121.85 on the 8th of Jan 1973. And look what happened. Boom. 73 and 74. We just tanked on the S&P 500. We fell off a cliff. Alright, and we dropped massively. Actually, just under half. So, yeah, big moves there from the S&P, and it was huge drops. Then, of course, look what happened. We didn't reach our peak. It's not like we sprung back up. This weren't a crash. This was a 10-year period where we didn't go nowhere. No returns. If you'd invested in 72, 73... you'd have made no money. For look, we're in 78 here. February 1978, and we're still below the 73 highs. Let's keep moving sideways. Oh, look, there, boom. Where was it? Just here, 1980, July 1980, you'd have then start to see some money come back. You'd have saw some profits in your investment. So you have had 7 years of no profits. And that came from 73, 8th of Jan 1973. So that would have just been a dismal time in the markets. But what happened? What happened in the early 80s? Why was there a bull run in the 80s? Well, let's have a look at the unemployment rate. There we are, look. 1982, the unemployment rate was at 10.8%. Dovish Fed coming, printing money coming, business growth coming. Boom. Unemployment rate could drop. For 8 years, the unemployment rate dropped. And I'm talking big drops. And of course, what's that going to do to the S&P? Well, it's huge business growth. Huge business growth. Unemployment rate constantly going down, more and more people going back to work. So look at the bull market we had. Here we are, look, in 1982, 1980s. Boom. Look at this bull market. And obviously, we had a quick drop there in 87. But nothing on the sort of level. We didn't carry on going down. We didn't have a sideways period for 10 years. We were back up to the peak, literally within 2 years. And we had continued the bull run. All through the 90s as well. Look at this, look. It's going parabolic. But look, halt. 2000 hit. And of course, we know that was a peak again. So we just had a 20-year bull run from 1980 to 2000. And what did the unemployment rates do for 20 years? From 1980s to 2000s. Look, consistently going down. Till 1990, where yes, we rose up slightly. We rose up a bit. We rose up to 7.8% unemployment rate. But again, unemployment rates, boom, came all the way back down. Big number here again, folks, to below 4%. We hit below 4% unemployment rate in 2000s, early 2000s. Look at that. So we knew, oh shit, the last time we hit this was late 60s. And we had 10 years of nothingness in the markets. Then, of course, we had unemployment rates consistently coming down. We hit below 4%. So let's see what happened. Well, inflation started creeping up. to about 3.7%. So almost 4%, which is still nearly double the Fed's target of 2%, wasn't it? So we had to have a recessionary period, we had to raise rates, and there we are, look, boom, unemployment rates started creeping up. And let's see what happened to the market. We didn't go back to below the 4% mark, did we? We hit 4.5, 4.4, 4.5, 4.4. We didn't go back below the 4%, which is the main thing. So yeah, let's see how the markets performed. So unemployment rates were below 4% just at the start of 2000. And look at this, look. Since 2002, 2003, the market went down. It just traded downwards. You'd lost money. And then the market's just gone sideways. You could have invested in 2000, and look, we were up to 2006. You'd had no returns. You'd have still been down. Oh, look, we briefly went above it in 2007. But of course, what happened? Oh, inflation started to kick up again. Look at that. In July 2008, inflation was at 5.5%. In late 2000s, inflation was over 4%, which is obviously double the Fed's target. So we had a recessionary period. Of course, I know about the Lehman Brothers. Of course, I know the banks went bust. This added to the severity of the recession. But regardless of all that, say that didn't happen. They would have still had a recessionary period because inflation was high, okay? We would have still had a recessionary period. But boom, look, due to the severity of it, we hit unemployment rates at 10%. Huge recession in 2008. And of course, the markets didn't like it. Look at that. We dropped. And oh, look, this was the peak in 2000. If we come out a little bit, look at that. That was the peak in 2000. We didn't go nowhere on the S&P, just traded sideways till 2013. 2013, people. That's when the market made new peaks. You'd have made no money for 13 years. No money for 13 years. But of course, let's have a look what happened next. Look at this. Unemployment rates were severely high in 2009. Huge unemployment rate numbers there. And a lot of people were out of work. 10% there. So, boom. We had 9 years of unemployment rate consistently going down. Consistent. Boom. And inflation didn't really cause us a problem during that period, did it? I mean, look, if we think about it from 2009, look at this period. We went up to 3.7% inflation there. So we almost hit 4%. But look, inflation wasn't a massive issue. We didn't see the sort of 5%, the 6%. So, and of course, unemployment rate was consistently just coming down. So, what happened to the markets? Well, from 2013, let's do it from when the unemployment peaked. So 2009, October, November, December, 2009, 2010. So let's go to that period. Oh, look, here we are, look. October 2009, November, December, January 2010. So we were about round here. Okay, we were around this period. Look at the bull market we had. Of course, unemployment rates were consistently coming down month after month after month. And look at this huge bull market we had. All the way up through 2019. Look at this. Of course, 2020 we had the COVID crash. And then obviously unemployment rates went up. But they came crashing back down through printing the money and interest rates very low. And of course, if the employment rates are coming crashing down, the markets are coming crashing up. Or flying up, should I say. And the markets did fly up. Oh, the peak, 2022. 4,800. Where's the unemployment rate? Oh, shit. Big trouble. Shit. We're below 4% on the unemployment rate. Shit. We hit this early 2000s. Late 90s, early 2000s. Market didn't go nowhere for 13 years. 13 years, people. Oh, shit. The last time we done it before then was late 60s. I did just spit. Sorry. Getting too excited. But yeah, late 60s, look, unemployment was below 4%. Shit. The markets didn't move for 8 years. We're back below 4% now, people. What's the inflation at? Shit. It's at 8.5%. Shit. This is serious. What's going to have to happen? Fed's going to have to raise interest rates. Oh, shit, they've already started that. It's just a repeat of 2000 and it's a repeat of the 70s. Shit. Then what's going to have to happen? Well, recessionary period, unemployment rates go up. Shit, unemployment rate's going to go up. People are going to lose their jobs. And we're below the 4% thing, people. Every time it's been below 4%, the last two times, 2000, late 60s, markets went nowhere. Markets went nowhere. In 2000s, you didn't get any money, no returns for 13 years. Dreadful. Late 60s, you didn't get no money, no returns for 8 years. Dreadful. That's what we're going to see again. There will be no money, no returns till 2030. Dreadful. So now you're probably asking BG Dollars, like, look, where can I put my money? Where am I going to make some money? Because the S&P ain't going to move for the next 8 to 10 years based on this sort of data. So what should I do? Well, folks. This is what I love about investing. There's always a bull market somewhere. Cramer style. And of course, I think you already know, if you know a bit about finance, we're going to go over to gold. And as you can see on the screens already, 1970s. Unemployment's hit below 4% early 1970s. For the next 8 years, the S&P 500 went nowhere. But look at gold. We're at 38 bucks. 37 bucks. December 1970. 1971, 8th of November 1971, we were at 42 bucks. Look where we were at in 1975, people. 192 bucks. We fucking tripled, quadrupled in just 4 years. Huge returns. But of course, we know it didn't stop in 1975, did we? The S&P 500 didn't move till 1980. So let's see what gold's done. Oh, we had a time period where we were going down. Oh shit! Jesus! We went up to flipping 850, 860 bucks. From 40 bucks to 860 bucks. Are you off your nut? That's like Bitcoin moves. In just 10 years, we went from $40 to $850. And the S&P 500, what? It went nowhere. Why? Because unemployment rates were below 4% at the start of the decade, at the start of the 70s. If you'd have got into gold, you'd have made big money. If you'd got in the S&P 500, you'd have made nothing. Zilch. Zero. Now, of course, we know, okay, we rotate out of gold in 1980s. We go into the S&P 500. Because obviously the S&P 500 hasn't moved for 10 years. Gold's had its bull run now. Gold shouldn't move, or it should go downwards for 10 years. It should go down or trade sideways. And oh look. Boom. Look at that, look. It went down, again down. We traded sideways. Till 1990, 1991. But hold on. I know I mentioned 10 years, but of course in 1991, 1992, we had unemployments go back up. And they consistently came down. So what does that mean? If unemployment rates are high, you want to be investing in the S&P 500. If unemployment rates are really low, especially below 4%, you want to be investing in gold. So unemployment rates were high, the S&P 500 hadn't finished its move. And of course, we know the S&P 500 absolutely went berserk during the 90s. So of course, gold would not have gone or done anything. And there it did, look, it just traded sideways. Throughout, and look at that, late 1990s, we went down. Oh shit, here's 2000, 2001. Shit, people. What happened? Let me think. Oh, I remember unemployment rates being below 4% early 2000. If unemployment rates are low, we invest in gold. Oh, I also remember the S&P 500 did not move for 13 years, from 2000 to 2013. So, of course, if the S&P 500 didn't move, and we just had the S&P 500 bull market, we're going to have next the gold bull market. And let's see what happened. Oh, look, we started to rise. 2003, we were coming up again. Oh, look at this. Bomb. Look at that. 2006, mate, we were up to 700 bucks all the way from 270. Tripled your money. But look, we weren't done there. And of course, the S&P 500 didn't go anywhere till 2013. So we would just stay in gold. And look at that, look. Huge maneuvers. And of course, it was in late 2011 that gold started dropping off. But the bull market from 2000 to 2011, huge for gold, and the S&P 500 went nowhere. Now, unemployment rates were very high in 2010. So if unemployment rates are high, what do? Well, you get out of gold, don't you? And you go into the S&P 500. If unemployment rates are high, you invest in the S&P 500. That's the bottom line to it, people. It's that simple. So look, 2011, Unemployment rates, oh shit, they're very, very high. Gold's just had a bull run. The S&P 500 hasn't gone nowhere. Let's get into the S&P 500. And then you'd have had a bull run till 2020, didn't you? The S&P 500 done mental manoeuvres. I mean, look at this, look. From 2011, huge pushes up for literally 9 years straight. You'd have made a lot of money. But oh shit. And gold, look, didn't go nowhere. Traded sideways, it traded downwards for 10 years. And look where we are now. Still ain't really we're still below the peak in 2011. Gold's gone nowhere. S&P 500 has had a bull run. And another thing, unemployment rates, shit, they're very, very low. So what do? We get out the S&P 500 and we buy gold. What's going to happen to gold over the next 8 to 10 years? It's going to have a bull run because it's just traded sideways and downwards, look, throughout the last 10 years. What's the S&P 500 done? It's had a bull run for 10 years. Unemployment rates are below 4%. This thing's going to go down and it's not going to move. It's going to trade sideways till 2030. And gold's going to have its flipping bull run, right? So I'm investing in gold. And that economic data is flipping horrendous. It's a very stark warning to get out of stocks, that data. And if it follows suit again, unemployment rate's below 4%, inflation's very high at 9%, we're going to have a recessionary period to bring inflation down. Then unemployment rates are going to rise. And if they're below 4%, if unemployment rates are low, you invest in gold. If unemployment rates are high, you invest in the S&P 500. And if you'd have done that, you'd have made a lot of flipping money in the last 50, 60 years. And it will probably continue to be the case. So that's exactly what I'm going to do. I'm getting into gold, investing heavy into gold. I will be shorting the S&P 500. I'll be shorting stocks. I'm sorry you don't want to hear that, but look, I've just shown you why I'm doing it. Look at that. That is big news that I've just shown you. And it's worked every single time. Unemployment rate was below 4% in the late 60s. The S&P 500 did not move. Gold had a bull run. Unemployment rates were below 4% in 2000. The S&P 500 didn't move for 13 years. Gold had a huge bull run. Unemployment rates are below 4% in 2022. Guess what? S&P 500 is not going to move for 10 years. Gold's going to have a flipping bull run. That's the bottom line to it. And it's been PG Dollars. Thank you for watching. If you have been watching till this time, please do subscribe, leave a like. Comment on what you think on this data because it is pretty nuts. And yeah, I'll see you in the next one, people.